In this video we are going to explore a simple trade in the US dollar versus the Japanese yen in the 15-minute timeframe. The methodologies involved in here are primarily the market maker strategy and a few introduction concepts of the Newtonian trading strategy as well. However, as I said previously, this is a rather simple application of what you can find at the surface of these two methods. Let me remind you once again that you don't need too much price information to find high-quality trade opportunities. Remember that price action has a relatively short-term memory, which is a good thing because even a small piece of price action like we see in this chart is already packed with a lot of information. Worrying too much about what happened in the distant past will only confuse you and create analysis paralysis. Another thing that is very important to remember here is that you should choose one time frame and stick to it no matter what happens. The moment you start looking for clues in adjacent timeframes, you will be immediately distorting the correct framework on which you should trade. That's also another source of analysis paralysis. Traders often think they are getting ahead of others by looking at support and resistance levels in other timeframes, but in reality, the exact opposite happens. All the information you truly need is contained in the recent price information of the timeframe you chose to trade. If it feels like you're not being able to analyze price enough to derive the necessary clues to trade, you should increase your analytical power instead of increasing the amount of price data you look at. Even though this is a simple trade, you will see that there is a lot that can be said about this piece of price action. Let's start the analysis by looking at the price vector from number 1 to number 2. This is somewhat similar to the trade I posted yesterday that also had an exhaustion movement. Look at the difference in volatility between this vector and the rest of price contained in this chart. As I said yesterday, movements like these tend to be the final nail in the coffin of the market flow they are subscribed to. The fact that we have a very volatile vector in one direction means that one market player expended all its energy, so the only thing that's left is for the opposite market player to enter the stage and start a new flow, which will obviously be in the opposite direction. That's exactly what happened in this exhaustion vector between number 1 and number 2 and afterwards. Buyers exhausted their energy, and then sellers assumed the control of the major flow. Once again, the exact candle that finishes the buyer's exhaustion and starts the major flow down is a fractal candle. From number 3 to number 7 we see a major flow developing quite clearly by the creation of lower highs and lower lows. One interesting observation in here is that the retracement's vectors expand in time. For example, the vector between number 3 and number 4 has a short time duration. The vector between number 5 and number 6 lasts a lot longer, and the vector from number 7 to number 12 takes even longer. That tells us that buyers are attempting to bring the market upwards, but every time they try it becomes harder and harder to fight the sellers who are in control of the major flow. Notice that the vector between number 7 and number 12 is so long that it is possible to identify the minor flow going up inside. In other words, we can see the higher highs and higher lows of the minor flow from number 7 to number 12 in collision course with the major flow downwards. You will often find yourself in situations where the minor flow is in this collision course with the major flow. This is usually the time to pay attention for the area where both flows will collide. This is where the trade opportunities usually happen. Going back to the major down flow, we can see that the last solid structure of this market is in number 6. That was the starting point from the major sellers of this market, so based on the principle of price memory, we can probably count on these sellers in the future. In number 12 we can see that the buyers from the minor flow reached the level number 6, and this is where we need to increase our attention even more. I'm saying that because we cannot look at highs and lows as if they were just simple market extremes. The reason for that is that we have market manipulations, subtle flow shifts, and the intrinsic geometry of market vectors, which cannot be seen without the proper tools. In other words, there is a lot more to simple price extremes than what meets the eye. The problem is that most retail traders are simply not aware of this complexity. The result is that when they see price approaching high number 6, they will attempt to buy that level simply based on the idea of breakouts, which is a very shallow and unsophisticated way of trading. Here is where you need to be aware of the subtleties of market makers. Observe how the vector from number 11 to number 12 seems to be accelerating towards high number 6. Notice also how there is only higher lows on the way up on that vector if you look in the candle level. This is a common maneuver of market makers. In other words, large traders know that retail traders will always fall for the same trap of trading breakouts, so they can increase the intention of retail traders by accelerating price in the direction that retail traders expect. This sort of thing fills the retail traders with certainty. However, in number 12 is where things go south for the retail traders. Observe that candle 12 only pierces the high number 6, and then it closes below that level. In other words, the retail traders were triggered, so there is a massive burst of liquidity in the market. In candle 13 things get even more amazing because price creates an inside candle that touches the wash line from number 6. Beyond all of that, notice how the upper tails from number 12 onwards form a predictable pressing motion displayed by the sloped line. If you think that all of this orchestrated price motion is just a coincidence, you better think again about all of this. At this point in time, by knowing the work ethic of market makers, a trader can consider the possibility of riding along with them. The trade you see opened in the chart was triggered at the open of the candle right next to candle 13 as it is shown by the second red arrow. The stop loss in this trade is a no-brainer. You have a solid structure in number 6 and an alleged manipulation tail in number 12 happening in the same level. The stop loss should be placed a few pips above the tail of candle number 12. The target of this trade is where a very basic notion about the Newtonian trading strategy is used. Observe that I have a pitchfork drawn in the chart using high number 6, low number 7, and high number 12. In other words, a pitchfork drawn only in significant price extremes. The purpose of this fork in a situation like this is to pinpoint the probable level of exhaustion of price in the center line, so the profit target will follow the center line of the fork as price moves forward in time. This will give us a reward that is directly proportional to the time of exposure in the market. Let's see how the market develops. Here you can see that the trade hit its target in the center line of the pitchfork as it is shown in the red square. If you enjoyed this video, please support the channel by clicking the like button, subscribing to the channel, and by leaving your comment below. Don't forget also to check the other free videos in the channel and the strategy store available in the video description. Thank you for watching and I hope to see you in the next videos.